I want to read to you a document called the BlackRock Investment Institute Macro and Market Perspectives for August 2019, dealing with the next downturn from unconventional monetary policy to unprecedented policy coordination. Now, I want you to keep in mind, this is just before the Federal Reserve took space into the stock market 1 month after this was released, which was September of 2019. Now, summary. Unprecedented policies will be needed to respond to the next economic downturn. Monetary policy is almost exhausted as global interest rates plunge towards zero or below. Fiscal policy on its own will struggle to provide major stimulus in a timely fashion. Now keep in mind, this is before the pandemic. Given high debt levels and the typical lags with implementation. Without a clear framework in place, policymakers will inevitably find themselves blurring the boundaries between fiscal and monetary policies. This threatens the hard-won credibility of policy institutions and could open the door to uncontrolled fiscal spending. This paper outlines the contours of a framework to mitigate the risk so as to enable an unprecedented coordination throughout a monetary financial fiscal facility. Activated, funded, and closed by the central bank to achieve an explicit inflation objective, the facility would be deployed by the fiscal authority. And then there's bullet points we're going to go over. Bullet point 1. There is not enough monetary policy space to deal with the next downturn. The current policy space for global central banks is limited and will not be enough to respond to a significant, let alone a dramatic, downturn. Conventional and unconventional monetary policy works primarily through the stimulative impact of lower short-term and long-term investment rates. This channel is almost tapped out. One-third of the developed market government bond and investment-grade universe now has negative yields, and global bond yields are closing in on their potential floor. Further, support cannot rely on interest rates falling. Bullet point 2. Fiscal policy should play a greater role but is unlikely to be effective on its own. Fiscal policy can stimulate activity without relying on interest rates going lower, and globally there is a strong case for spending on infrastructure, education, and renewable energy with the objective of elevating potential growth. The current low-rate environment also creates greater fiscal space, but fiscal policy is typically not nimble enough, and there are limits to what it can achieve on its own. With global debt at record levels, major fiscal stimulus could raise interest rates or stoke expectations of future fiscal consolidation, undercutting and perhaps even eliminating its stimulative boost. Bullet point 3. A soft form of coordination would help ensure that monetary and fiscal policy are both providing stimulus rather than working in opposite directions, as has often been the case in the post-crisis period. This experience suggests that there is room for a better policy, and yet simply hoping for such an outcome will probably not be enough. Bullet point 4. An unprecedented response is needed when monetary policy is exhausted and fiscal policy alone is not enough. That response will likely involve, quote, going direct, unquote. Going direct means the central bank finding ways to get central bank money directly in the hands of public and private sector spenders. Going direct, which can be organized in a variety of different ways, works by, number 1, bypassing the interest rate channel when this traditional central bank toolkit is exhausted, and 2, enforcing policy coordination so that the fiscal expansion does not lead to an offsetting increase in interest rates. Well, they're referring to the repo. And keep in mind, this is before the Fed stepped in. So to say this is not planned and engineered, it is. Now, bullet point number 1, 2, 3, 4, 5, 6. An extreme form of going direct would be an explicit and permanent monetary financing of fiscal expansion, or so-called helicopter money. Explicit monetary financing in sufficient size will push up inflation, which is exactly what happened. Without explicit boundaries, however, it would undermine institutional credibility and could lead to uncontrolled fiscal spending. Bullet point 7. A practical way of going direct would need to deliver the following. Number 1. Defining the unusual circumstances that would call for such unusual coordination. Number 2. In those circumstances, an explicit inflation objective that fiscal and monetary authorities are jointly held accountable for achieving. Number 3. A mechanism that enables nimble deployment of productive fiscal policy. And 4. A clear exit strategy. Such a mechanism could take the form of standing emergency fiscal facility, standing repo. It would be a permanent setup, but would only be activated when monetary policy is tapped out and inflation is expected to systematically undershoot its target over the policy horizon. Bullet point 8, the size of the facility would be determined by the central bank, repo, and calibrated to achieve the inflation objective, repo, which could include making up for past inflation misses. Once medium-term trend inflation is back at target and monetary policy space is regained, the facility would be closed. Importantly, such a setup helps preserve central bank independence and credibility. Now, this is straight from BlackRock, before any of this shit went down, before the Fed stepped into office. Now, another thing. Everyone thinks I'm crazy for SPY 500 being a potential possibility. Well, if you look historically, if we go look at the dates where SPX and SPY has ran the most, if you look at the dates on this, they all tend to happen in October. If we look at, I'm trying to find the website that I found that has the all-time. I mean, I don't know why it's getting so hard to find it. S&P 500, all-time high, or most percent change in one day. There we go. So this is a list of the largest daily changes in S&P 500. Now, largest daily percent gains. Look at these dates here. The only time in history that the S&P 500 has gone over 10% in one day only happened during two periods of time. Once during the Great Depression, a few times during the Great Depression, and the other two times were in 2008. Now, it happened six times throughout its history. So we're talking since 1913, 1910, 6 times. And of those 6 times, we had one in March of 1933, October of 1929, October of 1931, September of 1932, October of 2008, and again in October of 2008. They happened on the 13th and the 28th. So if we had two 10% days in 2008, that's all it would take to close us out, basically at 500. Granted, we retrace back to those 420 levels. So it's not crazy. It's actually happened before, and this is likely the best possible time for this to happen, because the two greatest financial crises in history happen to be the same months, which was October, that the SPY finishes, or the SPX rather, finishes 10% or more in one day. So let's go, Brandon.